The last thing to consider when learning about the general journal is to ask, why do we even need one? So let's have a look. When we do need to record transactions in the general journal, why are we doing this when we can just put them straight into the ledger accounts in the general ledger? So for example, on the 1st of March, if I had a cash payment of $4,000 for rent plus GST, paid with check 123, I'd go in, I'd put the date, I'd write account was rent debit 4,000. GST clearing was a liability going down, so that was a debit 400. And cash was an asset going down, that was a credit 4,400. I put the narration in. Why are we doing that? Well, what we're doing is we're doing it so we can post it to the ledgers. So we went to rent and did a debit of 4,000. GST clearing, we went to a debit and did a debit of 400. And lastly, we went to cash and did one credit of 4,400, and we got our references right. So that's what we did. I guess the question now becomes, well, why don't we just put them straight into the ledgers? And that's what we've been doing for the first few chapters of the course. But now we're adding in this general journal. And so I guess we need to ask why. Why do both of these things? Why enter that transaction straight into the general journal and then put it into those ledger accounts in the general ledger? Why do we do both of those things? Why don't we just put them all in the ledger? So there's all our ledgers, for example, in what's called the general ledger. So we've got ledgers for all our assets, liabilities, owner's equity, revenues and expenses. But the problem here is when we've got that many ledgers, they're not in the real world all on the one page. They're in multiple files in accounting software. And it can be difficult to see everything at once and get a bit of a grasp of what's happened. So the problem with the ledgers is they're good at keeping track of totals, but maybe not each individual transaction. Secondly, if we had one transaction, say we were trying to find the matching credit to this this entry in the cash at bank ledger, and we'd have to go and find, well, where was it? Which other ledger was it? It was all the way over here in vehicles. That's not easy to find when they're all not on one page. Same with this one. You can see this transaction here, maybe that was a debit and it was split over these two accounts. That's not easy to track. Also, the information within each ledger isn't particularly useful. So if we took this entry, for example, I've got a debit in accounts receivable, 2,200, matched up with a credit in sales and a credit in GST clearing. So what's happened here is I've made a credit sale. But the problem here is I've got some questions that I can't answer just looking at that. I can't look at who did we make this credit sale to? What was their name? What did we sell them? What type of inventory? What was the invoice number? That's most important. If I ever need to track this, I need the invoice number. When is the account due? What was the cost of sale? So I'm missing all that. So what's better is that we record things in a general journal. So in this case, here we go. I've recorded this transaction and I've put in the cost of sale. So I can see that I've not only got a sale, but a cost of sale. So I know that. I can see what it was. It was a credit sale. I can see the product. It was 10 Nike LeBrons. I can see who I made it to, J. Johns. I can see the document number. That's probably the most important. And I can also see it says 30-day turns, which we'll look at what that means later in the chapter. But for now, I can see that this account is due within 30 days. So I've got so much more information by doing the general journal before I actually do all these ledgers. So what if there was also a mistake when I was recording things? So if you just look at this, this looks right. But if you just look at this, debit of 2,200 doesn't quite match up. I've got a sale credit 2,200. And 220 in GST. So I made a mistake in the ledger, and that's very easy to do because they're not in the same account. So I've got three accounts there, and they're often not on the same page. And sometimes I've got to flick back and forth. Yeah, there's a mistake. It's much easier to see that if I was just doing it in the general journal, because that would have shown up here and I could identify that pretty easily and go, something's wrong. So the general journal's good because before I go and enter something into the ledger, I've got to put it in the general journal first, and I can see whether it's been done correctly. So in this case, I can see there's the actual items that should have gone in. I can go and find that original invoice to double check the amounts, and it's kind of like a checking mechanism. So why do we need to record the transactions in the general journal? Well, if we could just sort of break it down, we'd say 1. There's way too many ledger accounts to make it easy for a business to locate, track, and analyze all of the transactions. There's just so many. And most importantly, those ledger accounts just don't have enough information in detail about what happened in each transaction. The narration in the general journal provides all the important information the business needs about each transaction, and I can use that to go and find the actual transaction in the actual document. And then I can go and track everything. And most importantly, we can use all this information as what we call the cross-checking mechanism. And that means whenever we need to find the details of a transaction, or if there is an error to be identified, investigated, and corrected, I can go back to the general journal, look at what was entered, and most importantly, look up that source document number so I can go back to the original transaction to see what happened. So if I had to sort of summarize this back to the theory and say, why are we doing a general journal? Well, it helps fulfill the qualitative characteristic of faithful representation. The information reported must faithfully represent the real-world economic event it represents. The user must be assured that the information is complete, free from error, and neutral. So the general journal helps the business ensure its transactions are recorded accurately and in complete detail that isn't available in the ledger accounts. And if there is an error, the general journal acts as a cross-checking mechanism that business can use to find errors using the source document number, investigate them, and fix them. So that's how it fulfills faithful representation. We could also say that the general journal fulfills verifiability. That means the accounting information must be verifiable, so it actually represents what it claims to represent. This is done by having a source document or evidence, avoiding using estimates, guesses, and subjectivity, and having information audited by an independent party. Well, a general journal helps the business track every single source document of every single transaction. How does that fulfill variability? Well, this provides the evidence needed to verify each transaction and its details against the information that was actually recorded in the accounting system, and that's how it fulfills verifiability.